to today's much anticipated Fed decision. Our next guest says the economy is at cross currents. Sonia Meskin, BNY Mellon Investment Management Head of U.S. Macro, joins us here in studio now. Thanks so much for taking the time.
Thank you for having me.
Perhaps the most important caveat is that you used to work at the Fed. So take us into what the thinking might be today, coming into a decision like this where we're expecting them not to raise, but to still be hawkish in some instance in the tone.
Yes, I think it's a very interesting point because the Fed needs to communicate that they're still very serious about inflation and the upside risks in inflation, just as it actually gently decelerating as we'd expected, and also as they're pausing instead of hiking again. And what they're trying to tell us is, yes, we'll skip this meeting, but we will potentially continue to hike. But they don't want financial conditions to loosen too much, such that there will be additional inflationary impulse potentially. It's a very difficult communication game for them. I'm very interested in what the summary of economic projections will say as a communication tool that they'd instituted in the previous cycle, and also, what the press conference will be about.
Speaking of that, in particular, the dot plot, what are we looking for in the dot plot that would signal, say, a potential end to the tightening cycle?
Yeah, I think that they will actually have to move up their GDP projections. They'll have to lower the unemployment projections for this year. And I'm very interested to see what the core PCE projection will be. As you know, the CPI is decelerating a little faster than the PCE. And we'd had more attention on the CPI because it's more directly related to the consumer. But traditionally, the Fed does look at the PCE measure more.
What do you believe the Fed is continuing to see in the front of, or actually coming out of, some of the bank turmoil that we saw in March of this year, and where lending stands right now, too?
That is $1 million question. Why? Because it's very difficult to triangulate exactly how much deceleration in credit to expect from this. I think they're, in fact, very happy that they've seemed to actually much lower potential fire sale risks of bank assets. The worries about the SVB and Signature Bank, et cetera, they held to maturity portfolios, those seem to have abated. And the Fed rolled out this new facility to aid with that very, very quickly after the SVB debacle. So I think they must be very, very happy with those results. But the longer term impact, as long as the yield curve remains inverted, it's a very challenging environment for most banks that borrow short and lend long.
It's so funny that the kind of banking crisis that we were dealing with has kind of become not necessarily a footnote, but it's on the back burner, the conversations about that. I just want to pivot a little bit and talk about just how the Fed has been managing inflation. It's come down. It's at 4% now. Obviously, their target is 2%. What's your assessment about how well or not that the Fed is doing in managing inflation?
Well, they really weren't doing all so well I would say in 2021. And in 2022, they really have tried to catch up. And they've done a lot of catch up. They raised rates very quickly, unimaginable, I think, for most folks who were anchored in the previous business cycle, right? At zero lower bound for a very long time. The path forward is much more difficult because it's very hard to determine how quickly the economy is going to react to this magnitude of hikes. It hasn't reacted as much, the real economy, not the banking sector, but the real economy has not reacted as quickly as I think was feared. But it's not to say that going forward, the reaction function of the consumer, of the housing sector will remain the same as it was in the last year.
All right. We'll have to put a pin in our conversation for now. Our thanks to you, Sonia Meskin, BNY Mellon Investment Management Head of U.S. Macro. Thank you so much for joining us today.
Thank you for having me.